Brad Thomas here with Forbes Real Estate Investor. I'm here at ReCon 2015, joined by Tom Nolan. Tom is the CEO of Spirit Realty Corporation. Good to see you today.
Great, Brad. Thank you for having me.
Great. Ticker symbol SRC. Tom, in the net lease space, one of my favorite sectors, very defensive sector for investors. Let's start out talking real broadly about your business model. You've really evolved since I've been researching your company over the last several years into a much more diversified company. You had some pretty large tenants that had a healthy percentage of your revenues. How have you evolved this portfolio and increased your diversification?
Well, thanks, and I appreciate the opportunity to have a chance to talk about Spirit. The company has been public for a couple of years. Its third-year anniversary will be in September. But we have been around, both privately and in its predecessor company publicly. And you're absolutely right. At the time of our IPO, we had tenant diversification. I don't want to call them challenges, but we certainly had a tenant diversification roster that wasn't as diversified as our overall objective was. And we had gone out at the time of the IPO saying we intend to become the most diversified company in the entire space. We view that as a real positive for security sense and diversifying your exposure. And we've done it principally through both the numerator and the denominator.
Right.
We did a very large merger with a privately traded REIT that doubled the size of the company. Of course, that got the concentration in half.
Right.
And then we have been selling off a number of the assets. Fortunately, it's a very good credit.
Yeah.
And that's been a positive. People weren't dissatisfied with the investment saying, well, gee, they're not a very good credit. They were just saying it's too big.
Right, right.
And so at the time of the IPO, we had one tenant that was a 30% concentration. There are 12 today, and they're heading south. We'll be in single digits soon. And I think the market's reacted very well to that.
Great. And let's talk about the evolution of maybe the balance sheet. I know Spirit has historically had a little more leverage than some of the peers. What have you done to really increase your balance sheet strength?
Philosophically, companies are either investment grade issuing bonds or they tend to be secured debt, and the market goes back and forth sometimes which model will work better. But Spirit was in the secured debt model, and the debt to EBITDA was higher than the peers. And I think my perspective, I look at managing a company, and I like optionality any place I can find it. I think that advances shareholder value. And I looked at the balance sheet and said, I want to shift this in a thoughtful way and create more optionality going forward. At the time of the IPO, we had probably $300 or $400 million of unencumbered assets.
Right.
The rest was secured. As we sit here today, $2.5 billion of unsecured assets. Our debt to EBITDA ratio has consistently gone down. It's at the lowest level it's ever been since the time of the IPO at our most recent quarterly report. And we're actually looking, we've done different raises, both equity and unsecured debt, in order to continue to effectuate it. And I think we'll be in a position in the foreseeable future, we're not setting a target date, but we'll be in an investment grade credit from a ratings agency standpoint.
Sure. And in terms of your acquisitions, are you seeing more one-off opportunities, or do you see any portfolio deals? And how big is the pipeline of net lease for your particular product today?
I think the pipeline is I got to say, it's as robust as I think I've seen it. We're in a sweet spot where there's a lot of product out there. We don't think we're stretching by any means in terms of making quality judgments or paying more than we're comfortable with. So we certainly like it. There have been a couple of good-sized portfolios out there. As it turns out, we didn't end up moving on those. We did $265 million of acquisitions in the last quarter, 7.6% cap rate, very granular.
Right.
And we did it over a series of over 20 transactions. You can do it a lot of different ways, right? You can buy 2 for $125 million, or in our case, you can buy 22 and get to 265. I don't think there's any right way necessarily, but the granular way does present. It continues to give you that diversification. You're not making any one big bet on any one credit. We've got at this point over 235 different tenants, different tenants, different credits. We're in 14 different industries, everything from medical office to retail to convenience stores. So really building the diversification.
Great. Last question, Tom, is in terms of your dividend safety. I know, like most REITs, had dividend cuts during the recession. Just a few, handful, a dozen that were able to increase. So, looking at your projection now, and you've been able to increase your dividend, how would you define your sustainability factor with your dividend?
I think it's very sustainable. That's a critical question in REITs. People are investing in us because obviously they like the portfolio, but there's a big cohort that are looking at that dividend and they want comfort that the cash flows are underwritable, the security is there. Our average lease term is 10.5 years today in our portfolio. We have the debt on our balance sheet is laddered out over a long period of time. So our cash flow is very predictable. And from that standpoint, that gives a lot of comfort in terms of the dividend. On top of that, there's a ratio that the industry uses, the AFFO coverage ratio, and that has been consistently coming down since the dividend. Or to put it another way, our earnings have been going up, and we've been sharing part of that with an increase in the dividend, and part of that we're reinvesting in the company, and the ratio's coming down, enhancing, ultimately the security of the dividend.
Certainly like to see a wide margin of safety there, so that's great. Tom, thanks so much for your time.
Terrific, Brad. Thank you.
Appreciate it. Thank you.